A McDonald's that served its community for 30 years just shut down for good, not because customers disappeared, not because the food failed. The owner said it plainly: the economics no longer work. When a business designed to survive anywhere gives up in California, it is no longer just a restaurant story. It is a warning about the state's economic direction. This was not a call made in a corporate boardroom. Scott Roderick ran the McDonald's at Stonestown Galleria in San Francisco for 3 decades. 30 years of Big Macs, Happy Meals, and McFlurries. In June 2024, he taped a letter to the door and walked away. He wrote that unprecedented changes to the economic landscape of California, coupled with ill-timed legislative mandates, had narrowed the restaurant's path forward. Translated into plain language, he could no longer make money. For Roderick, this was gut-wrenching. It was a family business, not an abstract investment. And when it closed, it joined a growing list of fast food casualties across the state. Over the past 18 months, California's fast food industry has lost between 1,000 and 23,000 jobs, depending on the data source. Pizza Hut eliminated 1,200 delivery driver jobs before the new wage law even took effect. Rubio's Coastal Grill closed 48 locations in one day and filed for bankruptcy. Again. In total, more than 500,000 fast food workers have seen their jobs, hours, or paychecks disrupted. This is not anecdotal, it is systemic. On April 1, 2024, California's minimum wage for fast food workers jumped from $16 to $20 per hour. That is a 25% increase overnight. The law applies to chains with 60 or more locations nationwide and affects more than 5,000 workers across roughly 3,000 restaurants. For workers, $20 an hour sounds like progress. For operators, it rewrote the math instantly. Multiple independent studies examined the impact. Academic economists found California lost roughly 18,000 fast food jobs relative to what would have happened without the wage increase. State employment data showed job losses exceeding 21,000 positions. Even a study funded by labor groups acknowledged more than 1,000 jobs disappeared, calling it the steepest decline outside the pandemic, and great franchise owners did not wait. In December 2023, Pizza Hut operators looked at the calendar, ran the numbers, and acted. They eliminated every delivery driver position across multiple regions of California. More than 1,200 workers lost their jobs. One driver with 9 years of service received $400 in severance. Pizza delivery shifted to third-party apps, pushing costs onto customers and workers alike. Rubio's Coastal Grill once had nearly 200 locations. On May 31, 2024, it closed 48 restaurants in a single day. 5 days later, it filed for Chapter 11 bankruptcy with over $1 billion in debt. Executives blamed falling in-store traffic, rising food and utility costs, and significant increases in California's minimum wage. 14 years earlier, the company had been purchased for $91 million. It was later sold to lenders for roughly $40 million. That is what economic compression looks like. One multi-unit operator estimated the wage increase added nearly $47,000 in annual labor costs across just 10 locations. Scott Roderick, who owned 18 McDonald's restaurants, raised prices 5 to 7% in 3 months and postponed equipment upgrades. When operators must choose between maintaining equipment and paying staff, the model is already broken. A Foster's Freeze in Lemoore, California closed on the exact day the $20 wage took effect. Employees thought it was an April Fool's joke. It wasn't. Workers later said something striking. Many would have preferred earning $16 an hour to earning nothing at all. That is the trade-off no headline ever mentions. For workers who kept their jobs, many lost hours. Research found 89% of fast food workers experienced reduced hours. 35% lost supplemental benefits. A higher hourly wage means little if weekly hours are cut nearly in half. Some workers now earn less overall than before the increase. Executives were blunt. McDonald's leadership acknowledged wage impacts would be passed on through higher prices. California restaurant prices rose 14.5% in just over a year, nearly double the national average. Chipotle raised prices 6 to 7% in 1 week in California alone. Meanwhile, McDonald's admitted customers earning under $45,000 a year are cutting back or stopping visits altogether. Fast food is no longer cheap. Some operators adapt aggressively. A family running 21 McDonald's locations survived by scrutinizing every detail: portion sizes, waste, even ketchup packets. That level of cost control keeps doors open, but it also shows how tight margins have become. Survival now requires constant optimization, not just strong sales. California's fast food industry is not dead, but it is transforming. Fewer jobs, fewer hours, higher prices, more closures. Businesses that cannot adapt disappear. Workers who remain face harder shifts. Customers pay more for less value. This is not just about hamburgers. It is about whether labor-intensive businesses can still function in California at all. As labor costs rise, automation stops being a future concept and becomes a survival tool. Self-order kiosks, mobile-only ordering, automated fry stations, and AI-driven scheduling systems are no longer experiments. They are replacing human labor at scale. McDonald's has already rolled out kiosk-heavy locations across California. Some stores now operate with fewer frontline workers per shift, relying on customers to place and customize orders themselves. This shift is not ideological, it is mathematical. When labor becomes the single largest and fastest growing cost, technology fills the gap. Every kiosk installed represents a job that will not return. Large operators with dozens of locations can spread costs, negotiate leases, and invest in automation. Single-store and small multi-unit franchisees cannot. They face the same wage laws, the same rent increases, and the same energy costs, but without the capital cushion. For them, one bad quarter can end decades of work. This is why closures are concentrated among older locations, mall food courts, and independently owned franchises. The industry is consolidating, not by choice, but by necessity. Fast food has long been an entry point into the workforce. It provided first jobs, flexible schedules, and a path for workers without formal credentials. As stores close or reduce staffing, those entry points disappear. Young workers, immigrants, and people re-entering the workforce are being squeezed out. When jobs vanish at the bottom, the ladder itself breaks. Higher wages mean little if there are fewer rungs to climb. Every fast food closure reduces more than payroll. Cities lose sales tax revenue, business license fees, property tax contributions, foot traffic that supports nearby businesses. In shopping centers and malls, one closure often triggers others. Anchor tenants leave, vacancies rise, and entire corridors decline. Municipal budgets tighten just as demand for public services grows. As prices rise, customers adapt. Value menus shrink. Promotions disappear. Portion sizes quietly change. Many low-income customers now choose grocery stores or skip meals entirely rather than pay $12 for a fast food combo. Executives have admitted it openly. The lowest-income customers are walking away. Fast food was built on affordability. When that promise breaks, loyalty fades quickly. These pressures exist nationwide, but California feels them first and hardest. Higher baseline costs mean there is less room to absorb shocks. When wages rise rapidly, margins collapse faster. Other states may follow years later. California is the test case. What fails here today becomes tomorrow's national trend. The goal was simple: raise wages and improve living standards. What was underestimated was how quickly businesses would respond. Price increases happened faster than expected. Job losses came sooner than predicted. Hours were cut more aggressively than anticipated. Policies written with good intentions collided with economic reality. And the adjustment happened in real time, on the backs of workers and small business owners. If current trends continue, California's fast food sector will look very different in 5 years. Fewer locations, more automation, higher prices, fewer entry-level jobs. Only the most efficient operators will survive. The industry will still exist, but it will serve fewer people and employ fewer workers. His is not just about burgers and fries. It is about what happens when policy changes outpace economic flexibility. Fast food is simply the first sector where the math broke visibly. Other labor-intensive industries are watching closely and adjusting quietly. California now faces a difficult reality. Higher wages alone do not guarantee better outcomes if businesses cannot sustain them. The challenge ahead is balance, protecting workers without eliminating jobs, raising standards without erasing opportunity. McDonald's closures are not the end of the story. They are the beginning of a larger reckoning about work, wages, and economic sustainability in America's largest state. McDonald's is not officially leaving California. But when franchise owners with decades of experience close stores and say the math no longer works, the signal is unmistakable. This is not panic politics. It is economic reality. And the decisions made today will shape the future of work, prices, and opportunity in California for years to come.